Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She is considered one of the top global macro experts and covers many investing topics extensively in her free newsletter and a more in-depth paid investment research newsletters. Lyn Alden, thank you for joining me again.
Thanks for having me again.
So, Lyn, you've become super popular now. I think your Twitter, I was just looking at it with your energy tweets yesterday, last night. Over 400,000 Twitter followers. Your analysis is amazing. You cover a lot of different topics. So in your opinion, what are the biggest risks right now to the global economy?
Well, I think the number one biggest risk is energy security. I don't think that's super controversial, given the headlines around the last several months. And this problem was building for a while. It wasn't just because of the war, but that, of course, accelerated what was already a pretty fragile situation. And so Europe has significant energy security, and taken as a whole, that means the whole world basically has this current energy shortage problem. And of course, energy is like the key input into almost everything. So that means, in many countries, it's going to be a food price and shortage problem. And so that kind of translates into everything. And I think if there's a second problem, it's probably the fact that there's so much debt in the world that central banks are unable to use some of their normal tools to deal with inflation. And in general, they primarily use backward-looking indicators. So whereas in theory, they're supposed to be more like counter-cyclical forces on their economies, too often they end up being pro-cyclical economy impacts on their economies. And so, for example, right now, most leading indicators and kind of current indicators are suggesting, pretty significant downturn in economic growth, and we have central banks, trying to tighten policy into that. Whereas, if anything, if they wanted to tighten, last year would have been a better time for them to do that. So I think that we have kind of a perfect storm of a lot of problems coming together.
You and I are definitely thinking on the same page, because I was going to bring up that I think governments and central banks, their bad policies are the main problem, especially with energy. I am seeing almost every day just bad energy policy after bad energy policy after bad energy policy coming out from these governments. And I think you were writing articles about this over a year ago. So you didn't just hop on this trend. You've been warning about this for a while now.
Yeah, I guess something's right, something's wrong. Energy is one that I've been pretty correct on. Maybe it's because it's, I have like an engineering background, and it's just something I focus on a lot because it's so important. And so, yeah, last year I started writing a lot, really long form pieces around energy. And then I updated it. That the first big public one was, in the middle of 2020. Middle of 2021, and then I updated again in December of 2021 about basically, energy shortages, particularly oil and gas. And I wrote about uranium to my research subscribers back in 2020 as well. So this is a theme I've been tracking for, a year and a half, 2 years almost. And it's something that I think is, long term is just getting started, even though, if you destroy demand enough, you can push down prices temporarily. But I think that until there's more supply capacity coming online, this is going to be a problem. And to some extent, commodities are inherently cyclical. There's always periods of overinvestment, underinvestment. It's always challenging for companies that cannot control the price of their own product. But then, yes, when you add bad policy onto that, you can make the problem go from, like a normal level cyclical problem to a rather disastrous outcome.
And if we did have a crash in energy prices, I think things would play out similarly. I don't know if we're going to have negative oil futures, but I think we would have a very big snapback rally within 2 or 3 years, very similar to what happened in the first quarter of 2020, where oil prices crashed, natural gas prices were in a bear market for a long time, a ton of supply came offline, and then here we are now, about 2 years later, maybe a little over 2 years later, and look where the oil price is, despite the global economy slowing down enormously, despite policy decisions that look like they're trying to kill energy demand.
Yeah, I think it's, I would describe it as trying to like hold a beach ball underwater, where, if you put a lot of force on it, you can hold it down temporarily, but as soon as you let go, it's going to come back up. And so, to the extent that they want to engineer enough demand destruction to get a severe recession, that of course can, temporarily bring down the price. But then as soon as they encounter too much pain in that recession for their own liking and they want to stimulate out of it again, I think the energy problem is going to be right back there. because we don't see a lot of supply coming online anytime soon, especially long-term supply, right? So, some of the longer term projects, 7+ year projects, we don't really see a lot of that coming along because there's a lot of risk bringing like $1 billion gigantic long-term project online. If you look at oil futures out a few years, they're priced cheaply compared to current prices. And so they're basically telling oil company CEOs not to invest too heavily because the market is still kind of pricing in transitory high oil prices. And so there's not a lot of incentive, after the whole 2010s, especially, especially the second half, oil companies were, kind of that middle part of the decade, actually. Basically, a lot of oil companies, especially in the US and Canada, were bringing on supply that was not profitable. They were just bringing on this non-free cash flow positive supply. And eventually, investors got sick of it. And ESG mandates made a lot of investors want to, divest out of it. And so that space, we had hundreds of bankruptcies in the US in that space. And the remaining oil companies had to be more disciplined with their capital deployment. So instead of just constantly issuing debt and equity to drill unprofitably, they had to start focusing on profitable growth and paying down debt and being more conservative. And I think that's going to be here for a while, especially when, there's a lot of, environmental pressure on them as well. And then now when you see headlines about windfall taxes or oil price caps and things like that, not a lot of outside capital necessarily wants to pour into that sector, even though the prices are pretty high right now. And so I think it's just kind of a perfect storm of stagflationary policy that I think can persist for quite a while. And one more point I'd make is that if you look at the whole post-World War II period of global energy consumption, so not just one country, but the whole world, there were only 3 periods where the whole world had like reduced year-over-year energy usage. And so that was for a few years in the early 1980s, after the whole Volcker raised the dollar, it basically raised interest rates, raised the dollar. The whole kind of world economy went into a pretty significant recession. You had a lot of emerging market slowdowns, debt crises there. So that was like a big, down couple years where energy was not growing. Then you had, of course, the global financial crisis. That was 1 year of down energy usage, and then 2020 with the lockdowns was the third. And so periods of global energy reduced demand consumption are very rare, and they're associated with like the most severe economic situations of this whole modern era.
To add to your points there, also, we're not seeing, you talked about the amount of capital, the time requirements to bring on an enormous oil field. And we're not finding a new Guar, a new Cantarell in Mexico, Guars in Saudi Arabia. We're not finding these giant oil fields that are low cost, that have enormous wells, that pay back quickly. The return on energy invested, the capital costs are enormous to find future oil production, and they take many, many years. A lot of them are deep water, and the shale wells, those deplete very, very rapidly. I think within 3 years, they deplete or over 90%. I think they're enormous depletion, but there's just not a lot of supply side investment. We're not seeing a lot of new mines come online, even though the copper price got close to $5 a pound. Bringing a sizable copper mine online takes many, many years, could take a decade and over $1 billion of investment. So the supply is not going to come online quickly. And then OPEC, with the energy point here, we'll stay on energy for a little bit longer. Just the OPEC data, Lyn, that's come out in the last 12 months. I mean, OPEC has every incentive to grow their oil production right now, to grow natural gas production. And if you look at the data from them raising their production quotas, they're just not meeting them. The OPEC plus countries are missing their production quotas by over 2 million barrels a day, and it just keeps getting worse. So even though they're officially raising the production quotas, they're not actually producing more oil.
Yeah, there are some people like Josh Young that have been covering that pretty frequently and kind of calling it ahead of time, which is basically saying that they think OPEC spare capacity is less than consensus thinks. And I think that the data is making that credible because, like, as you pointed out, they have every incentive. Normally the incentive is the opposite. They try to produce more than they're allowed to kind of sneak in a couple extra barrels. And of course, right now we're seeing that many of them are unable to meet those quotas, despite the fact that prices are this high, and it's kind of several countries are looking at it as like a national emergency. And another point I'd make is that both China and the U.S., so the two biggest economies in the world, two biggest oil consumers, are both taking steps to basically reduce oil prices. So the U.S. is drawing down its strategic petroleum reserve, and China has these like multi-month lockdowns. This past couple months, and if you look at flight data, for example, they have like they've crushed their their driving and their flying industries back down to what they looked like in the worst parts of 2020. And so China is basically, whether it's related to energy prices or not, or their political infighting, whatever their causes are to do this level of lockdown that they're doing, they are reducing China's oil consumption significantly at the moment. And so these high prices we see right now are despite the fact that the two biggest oil consuming countries are, the U.S. is adding supply to the market, and China is pulling demand off the market, and these are the prices now. So if we get to a period where the strategic petroleum reserve is no longer able to pull down, and if we have some degree of China reopening, those are two upward forces on oil prices that would have to be offset by either new supply coming online or demand being destroyed that badly elsewhere. And so that's why I think that although they can probably hold prices down for a period of time, there's no clear end in sight in the next few years to have any sort of cheap energy, other than in the depths of a really, really severe economic crisis. And some of the other things that they could do is have more nuclear and have more things like that. But those are also very long lead time projects. So our LNG terminals, pipelines, these take a lot of capital expenditures. And the price of doing all that is much higher now, of course, because you have some labor wage inflation. The parts to build all that stuff has it generally inflated. The transport costs and the construction costs are all higher. And so I think that basically this is a longer term issue than the market thinks. And I think that we could have a situation where they get oil price down temporarily. The market's like, oh, look, it's transitory. But then as soon as they have some sort of stimulus again, then it just shows right back up.
And then it's a rally similar to what happened in 2020, where you have a mini crash, very painful for a short amount of time, maybe 12 months, 18 months. And then there's an enormous rally. And this volatility is just going to absolutely blow people's minds, because 2 years ago, people were paying record low for gasoline prices here in the United States. And now the swing in 2 years, now they're paying record highs. If they can find diesel, I mean, there's shortages now of diesel. The US is still exporting this stuff, gasoline, diesel to Europe. It's a mess. It's bad policy, though, because you were tweeting out yesterday about Germany's bad policy for nuclear power. I mean, they can't get the natural gas right now that they need. They didn't build liquefied natural gas, the facilities there to have that. They can't bring in the coal quickly, and the green energy ESG people don't want that. And then they are shutting down nuclear power reactors. I think France is also at like a 20 or 30-year low for the amount of nuclear power that they're generating inside their country.
Yeah, it's really, managing to optics rather than outcomes. And it's kind of, now they're kind of paying the price for that. And there is when I started talking about uranium back in 2020, I was citing this research study. I think it was actually by the National Bureau of Economic Research here in the US, but they were talking about Germany's energy situation. And they basically estimated that, Germany could have reduced their coal usage if they had not shut down their nuclear power, right? So they could have taken off, they could have significantly reduced what is basically the dirtiest type of fuel, to have, keep more of their existing clean fuel. So they basically made the least green choice they could do by taking off their nuclear and leaving their coal. It's also challenging because nuclear takes much longer to build than coal. And so now they're the whole European continent really is paying the price for this, not just in Germany, but elsewhere. And they don't really have a lot of great outcomes at the moment. And that's why they're stuck doing rather weird policies while they're in the middle of an inflationary crisis. So there's so much debt in the system that the ECB, for example, has to monetize Italian bonds, despite the fact that inflation is officially in the high single digits and energy price inflation looks like a Weimar chart.
And natural gas prices in Europe are even higher than natural gas prices here in the United States. And we're recording this interview on Monday, June 20th, 2022 for our listeners out there who want to know the date, because I always get asked that. But these natural gas prices, these energy prices, Lyn, this is affecting food too. This is affecting fertilizer. This is affecting food. Then these governments have these protectionist policies now. It seems in the last 6 to 8 months, I think it started with Russia in February. They banned fertilizer exports. And then a lot of these other countries started either started banning fertilizer exports or banning wheat exports and other staple crops. So do you think this food crisis and this energy crisis is exacerbating the food crisis as well?
Yeah, I think so, because it's obviously a key input for fertilizer, and just in general, farming is a very energy intensive process. Not a lot of people realize that. And so energy costs have direct implications for food costs around the world. And when the pie is not growing, countries get more combative. They get more protectionist. At worst, it can turn into kinetic wars, and at best, it's just trade wars, things like that. And now the U.S. is considering export bans on diesel. And so basically, a lot of the disinflation, the disinflationary trends we had over the past 25 years were from opening up of global trade, and basically geographic arbitrage. So if you look at a chart of oil price spikes, like let's say 5-year rolling, like how much oil went up or down over 5 years, and you do the same for official CPI, so 5-year rolling number. So it filters out the annual noise. It's actually kind of these longer trends about inflation and oil prices. Throughout history, they've generally been very, very correlated. If oil price spikes, that contributes to a CPI spike. It's kind of the key driver in that. And the one in the 2000s was the one exception where you got this huge oil price spike. But in the developed world, you didn't really see a lot of inflation. You had pretty mild inflation in that decade compared to what you'd expect from looking at that oil price. And it's in large part because we export a lot of our inflation to China and the rest of the developing world, where a lot of our marginal workforce was basically popping up in those countries, and so we weren't getting the type of domestic wage pressures we'd normally see in that type of high oil price environment. And so we were able to kind of detach ourselves from that last oil price spike. But now, because of deglobalization and because Chinese demographics have pretty much peaked out, and so they're no longer this gigantic, like unlimited sink for global labor, I think that this oil price spike is going to translate into more persistent CPI problems, and also just obviously real inflation behind however they want to calculate the CPI. The other ways of trying to measure broad segment of prices. I think this could be a bigger problem for developed, the whole developed world than it was in the 2000s decade.
I've also seen interviews on the China Insights YouTube channel that are translated into English from Chinese factory owners. And you're talking about labor costs and some of these other costs, parts, materials, plastics are up, but they were talking about their energy costs. And the Chinese government was either forcing some of these factories to shut down since really July of 2020. It was 2021. I think it was mid 2021. This stuff started. I started seeing news stories in early to mid 2021 that China was shutting down the factories because they had a energy and electricity shortage. So they were diverting the electricity away from the factories. But the cost for these factory owners in China are up 10x for some of these factories. So if their electricity costs, their power costs, their energy costs are up almost 10x compared to factories in other countries, they're not going to be able to export deflation anymore with cheap manufactured Chinese goods.
Yeah, exactly. And there's, I've seen different analysis on why they might be having some of their power problems. I'm not, their market's pretty opaque, so I don't know the full reasons. But there have been estimates, for example, that they might be having groundwater shortages. And of course, most types of power are heavy users of groundwater. They use a lot of water. So you wouldn't, most people wouldn't expect how much water a coal plant uses or a nuclear plant. They use a ton of water. And so it's possible that they've built so much of an industrial base in their country that they're having trouble sourcing water that runs a lot of this power. But whatever the reason is, yeah, they're having power shortages, and they don't really have the capability in terms of labor or industry to give the world the same disinflationary trend. So during this whole 25 years, we've had, relatively rapid broad money supply growth in most of the developed world, but you had less inflation growth than you'd expect from that level of money supply growth. And a large part is because it was offset by some of these disinflationary globalization trends. And it's just that whole tranche isn't there anymore. We basically sacrificed, resiliency to have as much efficiency as possible, and now we're in this. Now we're kind of paying for that, and now there's an increased view towards resiliency, but that's inflationary. And the way I've described it is that it's not that we shouldn't be shocked by how inflation is going to be high this decade. We should be shocked by how low official inflation was in the past decade, because a lot of those were these one-time unusual disinflationary trends that helped us push out a lot of that inflation, and that's just normalizing now. That's just like that. Those unusually disinflationary trends are no longer with us, and so I think that any money supply growth that happens is going to more readily turn into price inflation going forward.
The just-in-time supply chain that the global economy relied on for decades that was working efficiently, it just doesn't work under a pandemic. It doesn't work under lockdowns with politicians, bureaucrats, and regulators changing the rules all the time. I speak to a lot of small business owners, and I just hear all these horror stories about their costs rising double digits, so well over 10%, if they can actually find the parts that they need to sell goods and services.
Yeah, and it's also it's a national security issue, kind of like how Europe is heavily reliant on Russian gas. The United States and Europe are heavily interconnected with China. So if we think it's a big deal how much taking Russia out of the global economy was, or at least trying to, they, other than their energy exposure, they're a very small percentage of global GDP, whereas China is a massive share of global GDP, and basically it's interconnected with the vast majority of S&P 500 companies. They're a big consumer market, they're a big production market, and so we're so intertwined with them now that it creates this kind of standoff. I mean, imagine if in the Cold War our supply chains were like completely interlinked with the Soviet Union's. That would have been a very different dynamic. That's basically what we've created now. Here, by the time we got to the 2020s, is that we are highly intertwined with another rising power. And so the two biggest countries in the world have this kind of Cold War type of rivalry between them, but then they're also very, very interlinked in terms of financial markets, manufacturing markets, supply chains, energy, the whole thing.
So I want to transition now to the U.S. federal government's finances, because there is a lot of stagflation. Governments are looking around for new tax revenue. If there is an official government recession, then that means, historically at least, that means lower income taxes, lower capital gains taxes on stocks, bonds, real estate. We've had the crypto crash, although I think it's rallying when we're recording this interview. And then lower sales taxes and lower property taxes for state and local governments. So what do you think the Fed can do? Can the Fed actually hike interest rates above 3%? Because if they keep hiking rates, aren't they going to break more things? Aren't they going to end up destroying the U.S. Treasury's tax revenues?
I think eventually, yeah. I think that they're not going to be able to tighten as much as they think they will. Kind of like how we've already seen that Japan and Europe have been unable to tighten really despite this inflation. The Fed has a little bit more room, but I think that they're going to run out of that room. And there's a couple kind of delayed functions. So one is that they issued a lot of treasuries ahead of time, so their TGA account's pretty full, and they got a lot of tax revenue in the past few quarters. And so their coffers are pretty full at the moment, but that's going to be a rather transitory situation, because going forward, the U.S. is more reliant on the stock market going up in terms of its tax revenues than many other developed countries. We're a very externally financed country. We run these big trade deficits, but then a lot of those dollars flow back into our capital markets as foreign investors take those dollars and buy our financial assets. So basically, we are this big economic engine runs on buying depreciating assets from the rest of the world by selling our appreciating assets, by selling our financial assets, our houses, our stocks, our just claims on corporate debt, things like that. And so without the foreign bid for constantly going into our markets, and without the stock market was 200% of GDP, and now it's down to like 150% of GDP. But either way, it's a very large segment of the economy. And so when you get that going down, that hurts tax revenues quite a bit, both in terms of capital gains, but then also in terms of the wealth effect is so significant for the U.S., more so than less financialized countries. And so when the wealth effect goes down, consumption ceases. We're also seeing that credit markets are tightening up. So corporate, the ability to the cost of capital for corporations, especially for junk bonds, is much higher now. The cost of mortgaging a home now, if you were to move or just to have a new home, buy a new home for the first time, basically anyone who's not locked in currently and tries to get into real estate, it's much higher than it was for them. Much higher monthly payment for their mortgage than it was a year ago, 2 years ago. And so all of this is going to transit into less economic activity and less tax revenue. And so the US is fine for another couple quarters, but then they're going to start to find that deficits are widening again, while there's not exactly a lot of foreign demand for treasuries. If anything, when the dollar strengthens, the foreign sectors becomes either not net buyers or could outright be net sellers of treasuries. And so I think that market's going to get increasingly liquid and problematic until they have to step in. And then it's awkward if there's pretty high inflation and they still have to step into treasury markets. That's basically, that's what you got in the 1940s. That's what we're seeing in Japan and Europe now. And the Fed might be in a similar position where they're stuck monetizing deficits, despite the fact that their mandate is supposed to be trying to raise an inflation. And the U.S., even on right now, as they project out for 2022, they're looking at roughly $1 trillion deficit. So it's 4 or 5% of GDP. And that's with unemployment officially at 3.6%. So basically, give it as good as it gets, in trailing numbers. And that's about as small as they can get the deficit. So of course, if you have a recession, that quickly starts to widen. And so I think that they're going to have, but this is kind of a lot of people are focusing on private debt, which is still a big deal. But I think increasingly the story of the 2020s is going to be public debt around the world, Japan, Europe, the United States, and elsewhere.
In 2008, US Treasury tax revenues collapsed. In 2020, tax revenues collapsed. And I would argue that that's one of the main reasons why the Fed panicked so quickly and announced all these emergency liquidity programs and announced quantitative easing, because of how quickly the tax revenues collapsed. And one of the main priorities for the Fed is making sure all levels of government are fully funded.
Yeah, the Treasury market and the repo market really are some of the quickest acting markets where the Fed will jump in if there's a problem. And so people often say, how far does the stock market have to fall before the Fed jumps in? And it's like, well, that's not the main market that if it falls 20%, they're freaking out about. So a more important market than that is the credit market. If the credit market seizes up, that freaks them out. And then even more than that, if something like is supposed to be super well functioning, like repo or like treasury market, if that breaks down, that's when they literally have like emergency meetings and step in. And so back in late 2019, there was the repo rate spike, and repo was heavily used by entities that were buying T-bills. And so basically that spike, if left unaddressed, would have translated eventually into the treasury market. It would have, that fire would have spread. And so you saw rather, within one day, the Fed had responded to try to reliquify the repo market, and then they had the transition into just directly buying T-bills. And so basically that was the whole famous, it's not QE, they were calling it. They were obviously doing QE, but then not calling it QE due to semantics around it being only T-bills and not T-bonds. And then when they had March 2020, when they had basically the lockdown crash, you had a dollar spike. Because there's over $13 trillion of dollar-denominated debt in offshore markets. Most of that's actually not owed to the U.S. Most of it's owed to Europe, Japan, China, multiple different countries. But it is denominated in dollars. And so you had basically dollar cash flows drying up as global trade came to a halt. But those debts are still due. I mean, those debts represent demand for dollars that have to be serviced. And so you had this huge spike in dollar demand. And the world was short dollars, but a lot of entities still had dollar-denominated assets, including treasuries. So they can sell treasuries to get dollars, and that market basically went no bid. Treasury market liquidity completely dried up. It was basically broken, and so you had an emergency meeting from the Federal Reserve, and they printed $1 trillion in 3 weeks, to reliquify the treasury market while launching that alphabet soup of different programs. And so I think that if you have a seize up of some sort in the treasury market, you'd have the Fed in there very quick. And, they might do the same thing again. And they also have kind of other ways they can reliquify the treasury market if it becomes a more structural problem.
I think you just laid out in detail how fragile everything is because of too much leverage in the system, too much debt. This is the problem with fiat currencies and bad policies from governments and central banks. These governments are too big. And then every time there's a problem, especially here in the United States with the Federal Reserve Bank, they think that they can just paper over it. Eventually, there will be consequences, although here right now, here in the US and in other countries, we are feeling the consequences. Regular people, we're getting much, much worse stagflation. And then unfortunately, I think our taxes are also going to go up too.
I think we'll see about the tax part because the thing is that we're going to have what looks like a divided government. Even now, we already arguably have a divided government because you don't really have like a filibuster-proof Senate on the side of the president, and based on poll numbers, there's a very very high probability that the government's going to be more split after the midterms, and so it's actually going to be very challenging for them to get through tax changes the next 2 years. And so I think, if anything, you could see, kind of like how in Europe and the UK, you're seeing these kind of like targeted energy stimulus. We see now they're floating ideas of like, in the US, basically taking away tax on gasoline and things like that. I think you could see some of these emergency policies to try to rein in some of the stagflation, but that just widens the deficit further. And so I actually think that part of why the Treasury market is going to be in a weird state for the next few years is because they have little control over their expenses. A lot of them are just kind of mandated into law, but they're also not going to be able to move the revenue side for at least the next 2 years, maybe longer. And so those deficits are kind of locked in, and then they're how much their spending is kind of locked in, and then as their tax revenue fluctuates based on asset prices and economic strength, their deficit can widen. And I think that's why we're going to see action from the Fed to reliquify that market in the quarters or years ahead.
About 80% of US federal government spending for their budget is normally locked in about 5 years in advance. So the average person, when they go and vote, or they see a politician talking on TV and thinking that the politician can take immediate action and cut a bunch of expenses, that's just not how things work here in the DC metro area.
Yeah, and it's also that they usually, when they're elected, they usually don't have like the full majority to do whatever they want. I often see people say the government's going to do this or the government's going to do that. Whereas, most governments in modern history in the U.S. don't have sweeping powers. They keep gridlocking each other anyway. Some would consider that a good thing. I mean, some of the best market action happens when government is gridlocked. But either way, basically, I think that we're in a situation now where there's very limited options for new revenues or tax, or certain types of tax cuts. I think it's just kind of policies kind of frozen in for the next number of years, and we're going to be hit by these events that are happening. And some of their policies cause this. Some of these policies, you could say added to it. And then at the same time, their hands are going to be somewhat tied on, their ability to do anything about the budget itself. And so I think that's going to be a structural issue for the Treasury market. I'm not calling for that right away. I mean, we are starting to see that the Treasury market liquidity is going down. So it actually is kind of starting to happen around the margins, but they don't have a lot of Treasury issuance at the moment. And it's because of the fact that they kind of pre-issued it. They had good tax revenue, so they lowered how much they expect to have to issue Treasuries for the next couple quarters. But I think when you look beyond that, it does get pretty messy looking for the Treasury market.
But didn't China and Japan just announce in the last week that they won't be adding to their treasury positions? I mean, Japan's going through a lot of problems now. Japan may have to sell their treasuries to get dollars if problems continue to arise with the Japanese government bond market and the Japanese yen.
Yeah, we're seeing around the margins that Japan already sold over $100 billion worth of treasuries. And that's somewhat lagging data. It's like reported with like a 2-month lag. So it could have been a little bit more by now. And then we also have, China actually announced back in, 2013 and 2014, that it was no longer their national interest to keep accumulating treasuries, and they've stuck to that. You've had kind of this flat to mildly down situation for Chinese treasury holdings. And then you can also look at the Federal Reserve has data. Basically, there's two kind of main sources for foreign treasury holdings. One is from the Treasury. That's the more complete set, but that comes out with a lag every month. And it looks back about 2 months. And then the Fed reports custody data because they hold a lot of the treasuries for foreign entities, for foreign official entities, their central banks, especially the smaller ones, and that represents about half of the foreign treasury market. And so that actually is updated weekly, and we're already seeing that as the dollar has been strengthening for the past several months, the foreign exposure to treasuries has been slowly inching down. So it hasn't become disorderly yet, like it did in March 2020, but there's basically no net bid by the foreign sector. So, individual countries might add, other individual countries might be selling, but right now their overall net foreign exposure is flat to down, which again is not a huge problem because there's not really much issuance in these couple quarters either. But the problem is if that situation persists and then they get to a part where they have to increase their issuance again, that's when I think you get a potentially disorderly treasury market.
Isn't there also many trillions in US Treasury debt that needs to be rolled over in the next 2 or 3 years? So it's the US federal government can't pay, for our listeners out there, the national debt is well over 30 trillion. We're never going to pay it back. It's going to keep growing. All the people in DC care about is servicing the debt, the interest payments on the debt, and the national debt keeps growing. But a lot of this debt has to be rolled over, which means that the debt has to be extended because we can't pay it back. So how much of this debt has to be rolled over then in the next 18 to 24 months?
Something like half of it. I don't have the numbers in front of me, but like something like half. Yeah, something like half of U.S. Treasury debt is short duration T-bills and short-term T-notes, maybe like a year or two, or 2 years. A lot of it actually is very, very short duration, and they've actually somewhat lowered their duration over the past couple of years. And so that basically represents a lot of money that has to keep rolling over and over again into treasuries. And so a lot of their debt is going to be adjusting upwards if rate hikes do materialize.
So if the Fed keeps hiking rates, then in the past, rate hikes would attract foreign investors to buy US Treasuries, but that's not really happening to the extent that it did in the past. So if the Fed keeps hiking interest rates, that's actually going to hurt the ability for the US Treasury to finance itself to pay the interest payments. And then wouldn't that mean that the Fed would have to restart QE or whatever they're going to call it this time? And then they would have to expand their balance sheet again and buy even more treasuries then to make sure the government gets funded.
Potentially, yeah. The problem, yeah. So they're like, let's say Japan, for example. Let's say you're a private Japanese investor, maybe not the sovereign, at the entity, but you're a pension fund there, and you want to buy treasuries. Generally, you want to hedge them back into the yen. Maybe not today because the yen's like going under this like abnormally rapid devaluation because of their yield curve control. But in a normal situation, they want to hedge their treasury exposure back into yen so that they don't, you don't want to take like 500 basis points of currency exposure risk for something yielding, 200 basis points a year, for example. And so they usually hedge that back into their own currency, or at least a big chunk of it. Raising short-term interest rates raises their hedging costs until you can have a situation where it's no longer profitable, despite the yield difference between U.S. Treasuries and Japanese debts, for them to keep buying U.S. Treasuries because after the yield after hedging becomes equal or even lower than their Japanese government bonds, and so they're only willing to then buy the treasuries if they're willing to take on the full, currency risk of a movement where, say, the dollar goes down compared to the yen, which happens period to period. And so, basically, when you hike the dollar, when we hike interest rates, it has a couple effects. One is it increases hedging costs, and then two, it strengthens the dollar. And so, all these countries with a lot of dollar-denominated debts, they have trouble keeping buying treasuries, and if anything, they become sellers of treasuries in order to get dollars. And the Fed still, they have a couple options left in terms of things they could do that are less bad optically than turning back to QE during a time of inflation. One is that they could adjust the supplementary leverage ratio for U.S. commercial banks, so they can have U.S. commercial banks have easier capital requirements, basically not have to count their treasuries on their balance sheet really as against their capital ratios. And that would effectively, that's like jargony, but basically it would allow them to buy more treasuries than they are currently. And so you'd have that, you'd have a very similar effect overall, but it would basically be on commercial bank balance sheets rather than the Fed balance sheets. So it would increase M2, but it would not really increase the monetary base. So that's one option that they could turn to. And actually Powell's mentioned that. There's a number of officials that are looking at that. They did temporarily do that for a year during the 2020 crisis to add some liquidity to the market, but they could permanently adjust some of those ratios a little bit to basically, give banks more firepower to hold treasury. So that's number one. And number two is that they can do the U.S. actually holds almost no foreign exchange reserves. So we have our gold holdings, we have a little bit of SDRs, very tiny, trivial amounts of foreign exchange. Most emerging markets, for example, many of them have 20% of their GDP in foreign exchange reserves, 30%, 40%, depends on the country. Developed countries often have 5, 10% of their GDP in reserves. The US is something like 1 or 2%, and it's all gold pretty much. Because we're the axiom of the system, we do not have foreign exchange reserves. And so if there's some sort of like disorderly currency problem globally and the dollar is going up and no one's buying treasuries, one thing that the Treasury can do, and actually the Fed can't do it unilaterally, the Treasury has to initiate it really, the Fed would help, is that they can actually decide to increase their foreign exchange reserves so they can actually go out and buy European government bonds or Japanese government bonds with kind of the caveat that those countries would then turn around and buy some more US treasuries as well. It basically relieve them of some of their QE pressures so that they can direct some of their effective QE to US treasury markets. And they could market that as some sort of Plaza Accord 2.0, kind of a global exchange rate stability accord, whatever they want to call it. They can call it something other than QE, but it would effectively be QE, but it's just through different mechanisms. So there still are these roundabout things they can turn to if they start to see disorderly treasury markets again. And I think this is going to be the kind of decade where you see wonky things like that happen just because of how much sovereign debt's in the system.
More rules changes from central banks. To explain that more simply, what Lyn is suggesting is that these central banks and governments might just change the rules, and then these governments will create their own currency out of thin air and then go and buy foreign government bonds of another government. So they're not doing QE, they're not monetizing debt of their own government debt, they'd be buying another government's debt. So if one government failed, the other one would fail like dominoes. This is absolutely ridiculous, but unfortunately, this is the type of bonkers new normal world we live in with stagflate tax lie.
Yeah, and it's something that we've seen, for example, Switzerland, because they always want to decrease their currency strength. So left to its own devices, the Swiss currency would be arguably the strongest currency because they run massive current account surpluses. They have low sovereign debt. They do have somewhat of a housing bubble, though, because their interest rates are so low. But basically what Switzerland does is that at all costs, they want to avoid their currency from appreciating too much. So one is that they were, until very recently, they were holding their interest rates at negative 0.75%, which is lower than Europe and the rest of the world. And so it kind of deters too much capital from going in. And two, they would just print Swiss francs out of thin air, and they'd buy like Apple stock. They would just buy, they weren't even buying.
Well, they ran the Euro peg, right, for 3 years, and then the Euro peg was a disaster, and then they took that extra capital that they printed, and then they went and created a stock hedge fund with the central bank. It was buying gold mining shares in Apple stock. I think they were at one point, Lyn, they were the largest shareholder of Facebook or whatever it's called now, Meta.
Yeah, they pretty much recreated the S&P 500. So if you look at their list of holdings, it's all like the U.S. large cap, and it goes down the list from there. They kind of buy things, in order of their market cap, more or less. So they end up owning a little piece of everything. As they've effectively become one of the biggest hedge funds in the world. If you look at their 13F filing, and so that's an example where it already happens in some of these countries. But yeah, you can have it for a very different reason if a number of countries are finding themselves selling U.S. treasuries and coming to U.S. and say, look, you can either buy some of our debt so we can buy some of yours, or I don't know, like figure it out. So you certainly could have kind of these weird accords where you have more global interaction around some of their debt markets. But that's only, like I said, there's multiple tools. They can do SLR changes. They could just outright go back to QE again, kind of like what you're seeing in Japan with yield curve control, in Europe with basically they're increasingly doing formalized spread control, where they don't want Italian debt to get too much higher yielding than German debt, for example. And so you have most of the major developed market central banks are in a tight spot with how much sovereign debt they have. and that they due to how high inflation is, they can't let those bonds kind of settle at a market rate, and so they're basically finding different ways to suppress those yields below the inflation rate, so that those debts can be inflated away, and so that those countries don't have a fiscal spiral.
This is giving me a migraine listening to all the rules changes. You naming them off, and there's even more coming, unfortunately.
Yeah, there can be ones I didn't think of. Like there's all sorts of different levers they can pull when things get messy, and they're basically ways of disguising monetization of government debt, without necessarily calling it that. And so during the 1940s, for example, I often like to use that example where the Federal Reserve did yield curve control. So, inflation averaged about 6% during that decade, from the early 40s to the early 50s. It got as high as 19% year over year at one point. And they had held short-term rates at almost zero, and they capped long-duration treasuries at 2.5%. And the mechanism for that is that they had unlimited bid in order to buy any treasuries that tried to go over that peg. And effectively, for the first few years, they had to do that a ton. They had to basically increase their treasury holdings tenfold in order to take all that supply off the market, just kind of monetize a huge chunk of debt. But eventually they kind of shifted around, and they had the commercial banking sector buying a lot of it. And so, right now, if you look at treasury holdings as a percentage of total U.S. bank assets, it's at a multi-decade high right now. They're basically very exposed to treasuries. And the last time they were this high was the 40s and 50s. So basically a lot of that war funding back then, the huge government debt to GDP, in addition to the Fed, a lot of it was funded by the U.S. commercial banking system. And so that's why I think that SLR rules changes, especially because Powell's been mentioning them as a possibility, I think are another lever to watch. So there's a handful of levers that they have. It's obviously impossible to predict for sure which levers they're going to use in which order. But I'd be on the lookout for ways for them to reliquify government debt markets without necessarily calling it QE.
I think in China, they lowered their reserve requirement ratio similar to what the US did in 2008, 2009, down to zero or around zero. So the banks can theoretically have unlimited leverage ratios, but that's keeping the banks afloat so they don't look insolvent because of falling real estate prices. So all these governments are just changing the rules with their banking system. The average person out there who's listening to this, we're speaking about a lot of complicated banker terms. It's going to be very difficult. You just have to try to pay attention to the rules changes as best you can. And experts like Lyn are going to try to simplify things. But what we're saying now, it could be totally different a couple weeks from now or a couple months from now. That is how much the rules could potentially change going forward. They could change every couple months, unfortunately, going forward.
Yeah, there's been a number of rules changes to money markets and things like that over the years, mainly to get them to hold more treasuries. And then when it comes to U.S. banks, the main, historically, the key thing to watch, of course, is the capital ratio. So they're not really constrained by their reserves. They're constrained by capital. Basically, how much capital do they have relative to their asset base? And so I think one of the key differences now is that banks are going to face some troubles in the years ahead, but it's not the same as they were in like 2007 because they have a larger percentage of their assets focused in kind of nominally risk-free assets. And so they're very exposed to inflation, but they're less exposed to credit risk than they were, say, 14 years ago. But they still are significantly exposed to credit risk. And so I think essentially what we're going to see is that the banking system is going to be serving kind of like utility for, the Federal Reserve, basically serving as a way to soak up treasuries.
So I want to transition now the remaining part of the interview to bear markets and maybe commodities, gold and silver. Get your thoughts on that before we wrap up. So are we in a prolonged bear market now, maybe a long-term bear market in your opinion? And what types of asset classes have historically done well in past bear markets?
I think to the extent that we have a bear market, it's in significant ways, it's depending on what happens with energy markets and it's what happens with monetary and fiscal policy. And so one thing I like to point out is if you look at emerging markets, when they go through stagflation or recessions, depending on how high the inflation is, I mean, you can have stock markets going up in local currency terms, even when, of course, they're doing very poorly if you look at them in dollar-denominated terms. So they're really kind of, the denominator is melting along with the numerator not necessarily doing very well. And so it partially depends on how much inflation we get. But overall, I think that equity markets are going to be in for a very choppy environment in the broad sense going forward because their profit margins are going to be pressured. So the areas that I think I'm bullish on, one is that in stagflation environments, commodities generally do pretty well, but it's not a straight line. They're very volatile. I mean, if you were investing in commodities in the 70s, you obviously did very, very, very well. Commodities were their producers, but you would have pretty vicious pullbacks and counter rallies, kind of counter bear markets along the way. And so an investor really has to kind of know why they own what they own and be willing to just make sure they're risk managed and that that they understand the volatility that they can go through in these types of environments. Like we discussed earlier, they can temporarily crush oil prices potentially if they cause a severe enough recession, but then you could get a bounce back on the next leg up in stimulus. And so an investor has to look through that and not be shocked if something like that happens on a number of their commodity investments. Generally, in this type of declining PMI environment, so Purchasing Managers Index is kind of like a simple way to measure economic acceleration or deceleration. Usually when it's going down, as it is now, gold tends to do better than, say, copper, and tends to do better than broad equities. And so right now we've seen, for example, gold hold up surprisingly well, despite the uptick in rates this year. I think it also got an added kicker because starting in February 2022, we basically gave a gigantic announcement to the world of why they should not own too many treasuries or euro bonds, and why instead they probably sovereigns should look back into the gold market if they want to have sovereign reserves that don't have counterparty risk. And so I think we're probably going to see a decent sovereign bid for gold over the next couple of years. And generally, when you see something that could be having a bearish environment but is not, right? So the fact that gold is holding up well in the face of these rises in treasury rates, I think is very promising for that asset. And so I'm fairly bullish on precious metals. Risk adjusted, I like gold a lot, especially in this kind of declining economic environment. And so it's hard to say for sure what the dollar price is going to do over, say, a 6 to 12 month period. But I do think it's one of the places to have in a portfolio as something that is, I think it offers a lot compared to what other assets are offering when you have, basically Federal Reserve hiking policy into a deceleration. And then if you do get a Fed reversal of some sort, as we enter a deeper recession, gold would presumably be one of the ones to pop, because right now, there's a lot of good things in gold favor, but there's also, the strengthening dollar and rising rates are putting some pressure on it. And if those pressures go away, then gold has a chance to really kind of pop up. And so my base case has been kind of looking for somewhat of a cup and handle pattern on the gold price, but I don't try to predict exact gold prices or exact timeframes, but I do expect to see higher highs than we've seen recently. And actually, if you look over at gold in euros or yen, it's already doing quite well. And so I think in time, that will show up more and more on the dollar chart as well, if I were to guess.
And we're still at a gold price now at $1,838 an ounce, even though energy prices are up a lot for a lot of these gold miners. If you're a low-cost gold miner, you're still making a good profit margin. Some of these gold mining assets, the producing gold miners, we've started to see some mergers and acquisitions. The mid-tier, the lower-cost mid-tier gold miners are being targeted for acquisition. And the royalty companies, the larger ones, are just minting free cash flow right now. So I think we're going to see a mergers and acquisition boom in the next 6, 12, maybe even 18 months, perhaps sooner than that. I mean, I've been hearing buzz from smaller mining companies that they're already getting potential like negotiations for acquisitions in the not too distant future.
Yeah, you follow it closer than me, so I wouldn't be surprised to see that. And one thing to make note of is that partly what your assessment of the gold industry is will partially depend on energy assessment, because if energy is going up along with gold over a multi-year period, generally the royalty companies are very well positioned for that, because they basically don't have to worry about the expenses and they get the upside from the higher gold price. Whereas miners, their expense side does get squeezed. But of course, their revenue also does pretty well. So if someone has a specific thesis where they expect gold to do better than energy, the miners could be very interesting, because obviously you get them for a cheaper price, and they get good margins in that environment. But if you expect gold and energy to go up together, some of those royalty companies are very interesting because they're basically kind of a free claim on long-term appreciation. Just the caveat is that investors have to be able to put up with those higher valuations and expect that to pay out.
And unfortunately, for a lot of the mining companies, when the gold and silver prices do go up, so do all the other expenses, eventually all the other mining costs. So we have high energy costs right now, and the cost to build a mine is up. But if the gold price were to say to go to $2,500 an ounce in the next 2 or 3 years, maybe even sooner than that, if things go totally bonkers, then you could also have mining costs start to rapidly rise as well, even faster than they are now.
Yeah, I mean, if you had an environment of 2,500 gold, but then you had oil at 150, that for some miners would be better than others. But yeah, basically you'd have expenses and revenue doing well at these companies, whereas the royalty companies that's just pure margin. And so an investor just has to make sure they have a view on both the the revenue side and the expense side for any company that they're analyzing. And so I think for a lot of investors, just directly holding gold is a great way to have exposure. And then to the extent that they want to go out on the risk spectrum, they can look at some of the royalty companies, they can look at some of the diversified, mid and larger companies, and that they really have to have a lot of expertise if they want to get into the smaller companies.
So I'm looking at the companies that some of these well-respected investors with long track records of success, like Warren Buffett, Stanley Druckenmiller, David Einhorn. David Einhorn did an excellent presentation that he released on his Twitter in the last week or so. And he's a traditional value investor, and he disclosed that he's buying oil pipeline companies. He's buying oil and natural gas companies. He's buying base metal miners. He talked about adding exposure to gold, and he thinks gold's going to have a big rally. So do you think then, based on the actions of like these well-known investors that are buying mining stocks for the first time, and oil and natural gas stocks are buying them big, they're selling their other positions, do you think consumer staple companies, because of stagflation and taxes, they're going to be cutting dividends soon, and commodity producers, these low-cost miners and commodity producers, pipeline companies, they're going to be raising dividends? So we're going to kind of have the opposite of what a normal value investor would expect with these traditional consumer businesses, where they generate free cash flow, they have higher profit margins, and they raise dividends. Kind of the opposite is happening right now with a reverse wealth effect.
I think so. And if you look at that industry, it's still very underowned, right? So, maybe in the very near term, some of those oil companies and commodity companies got ahead of themselves. There's a lot of kind of fast money went in there pretty quickly. But I think that, as we get even any sort of mild correction, that remains a very interesting space long term, because you still don't see large pools of capital over allocated. Some of them, due to ESG mandates or other decisions, they're just not allocating at all. And there's not exactly a lot of retail enthusiasm for them either, right? So there's been some hedge fund exposure to it, but they're not over-owned in many ways. And if you look at, it's interesting you bring up energy pipelines, because I've been looking at that a lot in recent years. It's been one of my bullish areas, because there's really not a lot of fast money in there. So pipelines had two big rounds of getting utterly wiped out. So the whole 2014, 2015 oil price decline, a lot of them were basically doing Ponzi economics, where they were just constantly issuing debt and equity, and it was pretty reliant on high valuations. And so when you had, even though their underlying operations were not heavily affected in some cases by the reduction in oil and gas prices, their financials were. They basically just couldn't find aggressive buyers for their stuff anymore. And because they were so levered and so reliant on constantly issuing, they had to cut distributions. They had to sell some assets. Kind of the famous one was Kinder Morgan blowing up. And then some of the ones that survived that then ran into problems during 2020 when that whole industry got hit again. And so by now you've had a really big washout in that space. A lot of it's delevered. A lot of it is just more sustainable types of financing. And especially for the ones that still issue K1 forms, like the actual MLPs, the ones that have not converted into corporations, there's really no fast money in them, because it's kind of an added form during tax season. A lot of people avoid that, so you generally get a little bit of a valuation discount. And so for investors that are interested in like 3 to 5 year exposures to these high yielding, kind of asset heavy, hard asset type of investments, I do think they offer better, risk adjusted return opportunities than what we see in the broad market. But then I also think energy producers. And I think you have to watch out for areas of excess. So, for example, back, it was in mid 2020, I invested in some copper companies, and I expected to hold them for 3 to 5 years, but then within like 6 months, they just soared. Basically, the whole world, it was the whole reopening trade, and people were piling into copper in particular. And so it got really frothy from my view, and I ended up exiting that position, and of course it went up higher than I would have guessed, but then it came back down. And so that's something I'd like to eventually get back into, especially if you start to see another upturn. Right now, when you have a declining economic environment, copper can be pretty challenging. Generally, gold is better than copper when you have a decelerating global economy. And so right now I prefer gold. But in whatever the next upturn is, when I start to see signs of that, copper would be another area that I'd be interested in getting hopefully longer duration exposure to.
And fertilizer companies are not exactly sexy either, and their input costs are a lot of natural gas and other energy inputs. But Lyn, I don't see how we're going to plant more crops. I don't see how crop yields are going to go up without more investment by farmers into better farm equipment and into more fertilizer.
Yeah, I've been a long-term holder in Nutrien. That's been one of my holdings for a while now. I considered trimming it when it had that blow off top, and I didn't really get out of it. So it's had somewhat of a correction now. I think it's let off some of the steam, and it's back down to somewhat more reasonable levels. And so that's another diversified type of exposure I like to have for this whole space. I think this is going to be a decade of commodities, and I'm trying to do mostly a broad approach with my commodity exposures, and just kind of tilting away from whatever is getting excessive at certain periods. They start to go vertical and everyone's talking about it. That's where I might either trim or just not keep adding for a period of time. But I think that, especially on corrections, I do think fertilizer companies, I think that there's a lot of interesting things out there in the whole space, and that some of the increases we've seen recently are probably, just the beginning when you look back, say 5+ years from now, just with the caveat that I do think it's going to be a pretty volatile ride for some of these.
Oh, yeah, I agree with the volatility. I think that's the thing that the average investor or trader who's listening to this interview is not going to understand, that they've been chasing these potash stocks for the last 6 months, 8 months. They were chasing them all the way up, and now they're coming down. But a smarter investor was waiting for them to come down, was waiting for capital. They're looking on the charts for maybe a consolidation, correction and consolidation, for it to base for a little bit, maybe 6 months. I interviewed Dr. Mark Faber a couple weeks ago. He said the next 6 months, probably fertilizer stocks will bottom. These companies their profit margins, their costs are going up with natural gas, but their profit margins are still solid. A lot of farmers did not order fertilizer the last year or two. They bet that fertilizer prices were going to come down. And now you're going to probably start to see some more orders from the farmers who skipped out on some of the planting season because the demand for food is there. I think food and energy, and we've highlighted this at the beginning of the interview as we wrap things up here, I don't think the problems in food and energy, the supply side problems, the scarcity, I don't think they're going away. I think this is a long-term trend. If it's a long-term trend, it's probably a bull market, and it's probably investable if you do not buy all of your position at once, which is a very common mistake among a lot of investors these days.
Yeah, I think this will be a trend that gives a lot of entry points, and that you want to have an exposure to what you think makes sense, but then continue adding potentially rebalancing on periods of weakness and pullback. And I think that this bull market in commodities ends when you start to see a lot of supply come online. And so right now we started to see a price response, but we've still not really seen a supply response for most commodities. Around the margins, some of them are getting announcements for supplies coming online, but for the most part, there's not a rush of new supply yet. Some of this just takes a lot of time, and some of them just don't have a lot of incentive to do it right away. And so I think that a few years from now, several years from now, when you start to get a ton of capital just building out new types of supply, that's when you might want to start thinking about longer term exits. But right now, I still think we might have gotten over the first wave of commodity excitement. Some of the froth is getting out. Some of the copper froth is getting out. Some of the fertilizer froth is getting out. We saw a little bit of a correction in energy recently. So I think that some of that froth comes out, but that's when I would personally, especially if we're looking out a couple quarters, if we're in a significant recession, some of those more cyclical commodities I think could be on sale again, and I would look to probably reallocate to some of those.
And sentiment wise for the commodities, I mean, silver, I think, is one of the most hated. It's underperformed the other commodities by a lot. The sentiment for gold is very, very negative for US and Canadian investors. But gold prices have not crashed, unlike some of these other asset prices. So gold has kind of done its job. Despite a lot of people criticizing it, it hasn't crashed, 20, 30, 40, 50%, like some of these technology stocks, some of these altcoins.
Yeah, I like Incrementum's approach. So Incrementum is that fund in Europe, and
Money.
yes, exactly, and it's a number of them, and they invest in gold miners and stuff, but they also have like a fund that's like it's mostly gold, but then also has some Bitcoin in it, and they basically rebalance. So they benefit from the volatility of Bitcoin, and the stability of gold together. And so if investors only holding one, they had some pretty disappointing periods over the past few years where they would expect gold to be rallying and it's not, and instead Bitcoin's going up 10x, and then there's Bitcoin's getting utterly slaughtered down 70% and gold's just trying to kind of chopping along and holding its value. Whereas if someone has a decent chunk of gold and say a little chunk of Bitcoin, they rebalance it or they buy each one when they're kind of out of favor, which is what Incrementum's fund was doing. That's a pretty smart approach. Basically, it's like diversifying among the types of scarce monies. And so generally Bitcoin historically does very, very well in rising PMI environments. So the risk on, liquidity is flowing into the market. Bitcoin does well, and then you get bubbles in all these altcoins. And then most of them never get past another cycle. Usually Bitcoin does so far. We don't know the future. Whereas gold generally shines relative to other assets in more risk-off type environments, declining PMI environments, liquidity getting soaked up. And so I think that for an investor that wants exposure, some of those communities fight with each other. I like both in different allocations, along with all these other commodity exposures and along with some of the infrastructure like pipelines and things like that.
So last question before I let you go, and I've really enjoyed this discussion. We're a little over an hour. What are some ways people can beat or at least keep up with inflation in their portfolio or grow their incomes outside the stock market?
So I actually think one of the things I've been mentioning in the past several months when we started to get signs of food crisis was basically investors making sure that they have allocations to food and supplies in their own home if possible. Because I think that when you're in like this kind of risk-off environment, it's funny because this year we've had this raging inflation and cash has been one of the best investments to hold because most things have just gone down. So gold did okay, cash did okay, even though it's getting devalued. Whereas stocks are down, bonds are down, real estate's running into headwinds. But another cash-like investment that someone can do is just stock up on supplies, because as we all saw in 2020 during lockdowns. Supply chains are not very resilient. Things can disappear from shelves, and it's designed for just-in-time, delivery and kind of lean manufacturing and lean supply chains. So I think it's really up to households to have some sort of stock, some sort of buffer against periods of shortages and things like that. And so I can't really imagine a scenario where storing some non-perishable food and storing some supplies, paper product over a few years, doesn't do better than inflation, or at least keep up with inflation. That doesn't mean, build a bomb shelter and be a full-on prepper, but I think that it's just responsible for people and households to the extent that they have room and that they have some extra funds to make sure that their own kind of situation is secure as possible in terms of the things that they need on a regular basis.
I've kind of talked about this for a while now. So if people bought like a used refrigerator and freezer, especially like a used freezer on Craigslist, and then they set it up in their garage or somewhere else, they could have then vacuum sealed their meat, their protein, their steaks. They could have bought it 18 months ago, and then their protein costs would have been locked in. So they would have had meat available for their family, themselves and their family, at a much cheaper price because the cost of protein is up enormously, many different proteins.
Yeah, I think a basket of beef, chicken, fish, and eggs is up like 14% year over year, and that's the official number. Many obviously individual cuts are up way, way more than that. And so I think that's a good example of having nutrient dense foods stored away. And then, you've chronicled a lot the whole shrinkflation trend. Basically, there's a lot of inflation in consumer products, just basic, simple things like paper towels or laundry detergent, things like that. I think basically just having more than the immediate supply of things that you use is both good for security in general, and I think it's just one of the best risk-adjusted return things that someone can do if they want to allocate to something outside of the stock market, just to have a buffer for a lot of these goods that they use on a regular basis.
But something important with investments, though, are the rules changes. So unfortunately, people want an easy solution to difficult problems. Lyn, you've spent over an hour with me discussing all the difficult problems that these governments and central banks are trying to pull levers on. And in a lot of cases, they're making them worse. And then they're going to keep changing the rules. So the average person, they ask me about different investments or asset classes. Well, what are the rules going to be next week or next month? The rules are going to keep changing, unfortunately. And this is the type of new normal that we're in right now.
I think that's why diversification is important to some degree. That doesn't mean to own everything, but it means to know that there's a lot of things you can't know, partially because the world's very complex, and also partially because, as you point out, rules can change. And so I think that that's why some degree of diversification makes sense. So instead of focusing on one commodity, I want to focus on several and be able to focus on whatever's kind of out of favor or cheap at the moment or at the right part of the cycle, because rules can change on multiple things in the space. Same thing for other assets. And so I do think that knowing what you don't know is going to be a key, part of success this decade.
And as we wrap up here, all in on Bitcoin, all in on gold or silver, all in on rental properties, all in on technology stocks, all in on dividend stocks, these consumer staple dividend stocks that we just highlighted. The smarter investors are now lightening their portfolio of and moving into commodities. Shockingly, these are traditional value investors. So all in on anything in this type of environment, very, very dangerous.
I agree.
So Lyn, if my listeners want to sign up for your free newsletter or pay newsletters, how do they do so?
So I'm at LynAlden.com. Like you said, I have free and paid. I'm also on Twitter at LynAldenContact. So the most of my content's pretty free, so people can check that out.
Excellent. Well, I really enjoyed our discussion. I hope you did too. And let's have you back on in the next couple months.
Happy to. Thanks for having me.